Hey, thanks a lot, Scott.
I think what jumps out to me the most is the discrepancy between you and the chief market strategist of Bank of America, Savita Subramanian, who says her target for 2023 is 3,900 to 4,000 on the S&P. You're the Maryland Bank of America Private Bank CIO. You're 4,300 to 4,400? Is that right? Why the discrepancy there?
Well, actually, the 4,300 to 4,400 is basically a blow-off. It's well above the 3,900 note that we actually totally agree with Savita on in terms of what the markets are trying to get to. We're going to close the year somewhere around that, maybe a little higher than that. Well, actually, we think that 4,300 level is just upside to what the current view is overall in a more, what I say, a little bit more bullish scenario. So I wouldn't pay too much attention to levels. Rather, the theme for next year is the fact that the foundational element of what was just discussed a few minutes ago in terms of 60-40, a diversified portfolio, we're back to a foundational year. And you know, we had a 100-year terrible year with stocks and bonds. So perhaps it's not a very bullish thing to say that 60-40 is resurrected, but that's our foundational year for next year.
So in terms of the discrepancy between where the market is and where Powell is suggesting they're taking the terminal rate, who do you believe? Who are you betting with?
Well, actually both. I mean, we have to take the Fed's word for what it is by saying this is where we want to get it to. They're trying to talk down inflation the best they can. They're very worried about wage growth, the stickiness of that. They're worried about the employment market not coming down to levels that would suggest inflation is going to ultimately peak. But all we have to do is take a look at some of the inflation gauges and the components thereof, and we could see that inflation is coming down sharply. Matter of fact, the biggest surprise, at least for us next year, is the fact that it's going to come down a lot quicker and sharper than any expect. And the second surprise, even if they take it to the terminal rate of, say, 5.25, which the economist at BoA Global Research believes as well, they're going to have to back that off pretty quickly. The market is expecting 100 basis point cuts in 24 and potentially 25. That could actually get pulled a lot farther forward, closer to mid, dare we say, you know, the second half of 23, which ultimately becomes a tailwind for equities in our opinion.
So you are then decidedly in the camp that the Fed is more from here forward, all talk, little action.
Well, I think they're going to act. It's pretty clear that they want to take this to 5.25 into March end. Unfortunately, they have been saying, to your point, that they're going to stay on a pause for longer. The data will likely showcase to them that they can't. It's very difficult to create a so-called soft landing. Now, this time is slightly different. Consumers are a lot healthier going into this recession. Corporations' average debt on their balance sheet is almost double what it typically is. So they've done the right thing in their capital structure. So could they smooth out this recession versus the pre-pandemic ones? Yes. But unfortunately, housing means a lot to this economy. Goods-based manufacturing means a lot to this economy, and so is the world. So the data is going to start to go against them a little quicker. And I think Jeffrey Gundlach said it correct yesterday, where yields have come down. They're telling us that this could actually be a little bit harder landing than what the market is telling.
But wait, I mean, you just said that, but you also said that you see the Fed going to 5 to 5.25. So you can't have it both ways.
Exactly. And I think that's why markets are so confusing right now. That's why data is completely mixed. And the further we get into late cycle, the Fed is following the path of the employment market right now. And they're trying to talk down inflation based upon employment because of where unemployment is. And the window is open for them to raise rates because we're still at so-called 7% inflation, if you will, looking backward. And then they're going to have to toggle pretty quickly, at least in our opinion. That's why when we suggest that bonds outperforming in the first half and equities in the second half, very difficult to time that. So we want to be as diversified as we can. We want to be broadly neutral starting the year, so you're not moving in and out all over the place. And selection, Scott, you and this panel knows it better than anybody. Selection is going to matter a lot in 23, much more than what we've seen in recent years.